Most traders don't lose because the market is difficult. They lose because they make it complicated. Think about that for a moment. You've been told trading is about mastering indicators, finding secret strategies, decoding patterns that others can't see. But what if the opposite is true? What if the traders who last the longest are not the ones who know the most, but the ones who follow the simplest rules without breaking them? Let me ask you something. When you look at your past trades, how many of your losses came from a lack of knowledge? And how many came from ignoring something you already knew? That's where this begins. You watch the market. Price moves up, pulls back, continues higher, or it breaks down, rallies weakly, then falls again. The behavior is not random. It's consistent in structure, even if not in outcome. But here's the problem. You don't trust what you see, so you add confirmation, then more confirmation. You hesitate, you overthink, and by the time you act, the opportunity has either passed or turned against you. Why? Because complexity feels safe. But is it? Let's break this down. A simple rule in trading is not just a guideline, it's a filter. It tells you when to act and, more importantly, when not to. For example, only trade in the direction of the trend. Simple, right? Then why do so many traders fail to follow it? Because when price pulls back, it looks like a reversal. When a market moves too far, it feels like it has to turn, and in that moment, your mind starts negotiating with your rule. You tell yourself, this time is different. But is it really? Here's what most people don't realize. The market doesn't punish you for being wrong. It punishes you for being inconsistent. You can be wrong and still make money, if your losses are controlled and your rules are intact. But if you abandon your rules, even your winning trades become dangerous. So let me ask you, do you have rules, or do you have suggestions you follow only when it feels comfortable? Now think about your entries. How often do you enter a trade because everything lines up perfectly, versus because you're afraid of missing out? That small difference, that emotional push, is where complexity begins. You start bending your criteria. You justify weak setups. You widen stops. You chase price. And once you've broken one rule, it becomes easier to break another. Do you see the pattern? Here's the truth most traders avoid. Simple rules don't fail you. You fail them. And not because you're incapable, but because simplicity demands discipline. And discipline is uncomfortable. It asks you to sit still when nothing is happening. It asks you to wait when others are acting. It asks you to accept that you don't need to catch every move. And that's where most people struggle. So let me ask you, can you sit through an entire session and take no trades if your rule isn't met? Or do you feel the need to be involved? Now let's go deeper. A simple rule does something powerful. It removes decision fatigue. When your criteria are clear, you don't debate with yourself. You don't hesitate. You don't second, guess every tick. You either have a trade, or you don't. That clarity creates consistency. And consistency is what allows you to measure your performance honestly. Because if your actions are constantly changing, how can you ever know what works? Consider this. If you followed one simple rule for the next 50 trades, no deviation, no exceptions, what would happen? Not what you think would happen. What would actually happen? Would your results improve, or would you finally see where your edge truly lies? Most traders never find out, because they change something every time it gets uncomfortable. Let's talk about exits. Everyone focuses on entries, but exits reveal the truth about your discipline. Do you take profits according to a plan or according to how you feel in the moment? Do you cut losses quickly, or do you wait, hoping the market will come back? You see, a simple rule here could be cut losses at a fixed level, no exceptions. And yet, in real time, that rule feels negotiable. Why? Because loss triggers emotion, and emotion seeks relief. So you delay, you adjust, you rationalize. But every time you do that, you teach yourself that your rules are optional. And once that belief sets in, consistency disappears. Now think about this. What if your goal wasn't to win more trades, but to follow your rules more precisely? Would that change how you approach the market? Would you feel less pressure to predict and more focus on execution? Because here's the irony. The more you focus on outcomes, the more inconsistent your behavior becomes. But the more you focus on process, the more stable your results become over time. So ask yourself, are you trading to be right, or are you trading to be consistent? Let's bring this into application. Start with one rule, not 10. One, something clear, observable, non-negotiable. It could be, only trade breakouts with volume, only enter after a pullback in trend, only risk a fixed percentage per trade. Whatever it is, commit to it fully, no exceptions, and then watch what happens, not just to your results, but to your thinking. Because when you remove complexity, something interesting occurs. You begin to see the market more clearly, not because it changed, but because you stopped interfering with your own perception. And here's where it gets even more interesting. Once you trust a simple rule, you stop chasing certainty. You accept that not every trade will work. You accept that losses are part of the game. And in that acceptance, your decisions become cleaner, sharper, more deliberate. So let me ask you, what would your trading look like if you stopped trying to control every outcome and focused only on executing one rule perfectly? There's a quiet confidence that comes from simplicity. Not excitement, not adrenaline, just clarity. You know what you're looking for. You know when to act, and you know when to stay out. That's where better trades come from. Not from more information, but from better filtering. Not from more effort, but from better restraint. A rule only works if it survives discomfort. That sounds simple, but this is where most traders quietly fail. It's not during calm conditions, not when the setup is clean and obvious, not when the last trade was a winner. Rules are easy to follow when nothing is at stake. The real test begins the moment pressure enters the picture. Think about it. What happens to your rules after 2 losses in a row? Do they still feel solid, or do they start to feel restrictive? Do you begin to question them, adjust them, bend them just slightly to avoid another loss? That's discomfort, and it doesn't always come from losing. Sometimes it shows up when the market moves without you. You watch price run exactly where you expected, but you didn't take the trade because your rule wasn't fully met. Now there's tension, regret, urgency, and suddenly, the next setup doesn't need to be perfect. It just needs to feel close enough. That's where rules begin to weaken. Discomfort pushes you to act prematurely or avoid action entirely. It makes patience feel like missed opportunity. It makes discipline feel like hesitation. And unless your rule is strong enough to hold under that pressure, it becomes optional. But here's the part most traders overlook. A rule is not tested by how often it works. It's tested by how well you follow it when it doesn't. Anyone can follow a rule when it leads to profit. That's not discipline. That's agreement. Real discipline shows up when the outcome is uncertain, when the last trade didn't work, when your instincts are pulling you in a different direction. Let me ask you, when your rule tells you to exit at a loss, but the market is hovering just above your stop, what do you do? Do you close the trade as planned, or do you give it a little more room? That small decision carries weight, because in that moment, you're not just managing a trade, you're defining your standards. If you allow exceptions when it feels uncomfortable, your rule loses its authority. And once that happens, every future decision becomes negotiable. Now consider the opposite. Imagine following your rule exactly, even when it feels wrong in the moment. You take the loss. You skip the trade. You wait longer than you want to. It feels frustrating. It feels slow. Sometimes it even feels unnecessary. But something else starts to happen. Your decision-making becomes cleaner. You stop debating with yourself. You stop searching for reasons to override your system. You begin to trust the process, not because it always wins, but because it removes emotional interference. That's the real function of a rule. It's not there to guarantee success. It's there to protect you from yourself when pressure rises, because under discomfort, your perception changes. You see what you want to see. You justify what you normally wouldn't. You act not based on structure, but on relief, and that's where inconsistency begins. So the question isn't whether your rule is good. The question is whether it can hold its ground when your emotions push against it, because every trader has rules on paper. Very few have rules that survive real conditions. And the difference between those two is what separates controlled execution from reactive behavior. The market rewards consistency, not cleverness. That idea challenges how most people approach trading. Many come in believing they need to outsmart the market, to predict every move, to find something others haven't discovered yet. They search for the perfect setup, the hidden pattern, the insight that will give them an advantage. But let me ask you, how often does that search actually lead to stable results? Cleverness feels powerful in the moment. You catch a reversal early. You anticipate a breakout before it happens. You take a trade that others hesitate to take. And when it works, it reinforces the belief that you're ahead of the curve. But what happens when it doesn't? Because clever trades are often inconsistent by nature. They rely on interpretation, timing, and judgment calls that change from one situation to another. What felt like a smart decision in one trade becomes a mistake in the next. And that's the problem. Cleverness doesn't repeat easily. Consistency does. The market doesn't care how impressive your analysis is. It doesn't reward creativity. It responds to behavior that is repeated with discipline over time. That's where real results come from. Not from being right once, but from doing the same thing correctly again and again. Think about your own trading. Do your best trades come from moments of clarity and structure, or from moments where you tried something different, something slightly outside your usual approach? And more importantly, can you repeat those clever trades on demand, or do they depend on conditions you can't fully control? That's where most traders get stuck. They chase the feeling of a perfect trade instead of building a process that produces average trades consistently. But average, executed well, outperforms occasional brilliance followed by inconsistency. Because every time you change your approach, you reset your learning. You can't measure what works if your behavior keeps shifting. You can't build confidence if your decisions depend on how you feel in the moment. And you can't improve if every trade is based on a slightly different idea. So let me ask you, are you trying to be right, or are you trying to be repeatable? There's a difference. A trader focused on being right looks for confirmation, tries to predict outcomes, adjusts constantly to stay ahead. A trader focused on consistency follows a defined process, accepts uncertainty, and executes without unnecessary variation. One is driven by outcome. The other is driven by structure, and over time, structure wins. Because consistency builds something that cleverness cannot: reliability. When you know exactly what you're looking for, when your entries and exits follow a pattern, when your risk is controlled the same way every time, your results start to stabilize. Not every trade will work, but your overall behavior becomes measurable. And once it's measurable, it becomes improvable. Now consider the emotional side. Clever trading often brings emotional swings. Big wins feel validating. Unexpected losses feel frustrating. You become attached to being right because your identity is tied to your ability to figure out the market. But consistency removes that attachment. You're no longer trying to prove anything. You're simply executing, one trade at a time. Same criteria, same process. And that creates a different kind of confidence. Not excitement, but steadiness. So when you look at your trading, ask yourself something simple. If you removed all the moments where you tried to be clever, what would be left? Would your results become more stable, or would they fall apart? Because the market doesn't reward the trader who knows the most. It rewards the trader who does the same thing, the right way long enough for it to matter. Every broken rule trains future indiscipline. It rarely feels that serious in the moment. You adjust a stop slightly. You enter a trade a little early. You skip a condition because everything looks good enough. It feels minor, almost harmless. After all, it's just one trade. But let me ask you, when has it ever been just one? Because trading behavior compounds, just like profits and losses do. Every decision leaves a trace. Not on the chart, but in your mind. And when you break a rule and nothing immediately goes wrong, something subtle happens. You get rewarded. Not always with profit, but with relief. You avoided a loss. You caught a move. You felt in control. And your mind takes note of that. It says, this works too. That's where the shift begins. The next time you're in a similar situation, it becomes easier to break the rule again. There's less hesitation, less resistance. What once felt like a deviation now feels like an option. And slowly, without realizing it, your rules lose their authority. Think about this. Do you remember the first time you ignored your plan and it worked out? How quickly did that experience influence your next decision? Because success without discipline is more dangerous than failure. Failure forces reflection. It makes you question what went wrong. But a rule-breaking win reinforces the wrong behavior. It teaches you that structure is flexible, that exceptions are acceptable, that outcomes justify decisions. And once that belief settles in, consistency begins to fade. Now consider the opposite scenario. You follow your rule exactly, and the trade still loses. It feels frustrating. It feels unfair. You did everything right, and yet the outcome didn't reward you. So what's your next move? Do you stay with the rule, or do you start looking for ways to avoid that feeling again? That's the real test. Because discipline is not built through winning. It's built through repetition under pressure, through choosing to follow your process, even when it doesn't immediately pay off. Let me ask you, how many times have you adjusted your approach after a loss? Not because the rule was flawed, but because the outcome made you uncomfortable. That's another form of rule breaking. Less obvious, but just as damaging. You're no longer following a stable framework. You're reacting, and reaction leads to inconsistency. Here's what most traders don't fully see. Your rules are not just guidelines for trading. They are boundaries for behavior. They define what you will and will not do, regardless of the situation. And every time you cross that boundary, you weaken it. Not all at once, but gradually, like a line drawn in sand that gets stepped over again and again until it disappears. So the question becomes, how strong are your boundaries? Do they hold when the market moves fast? When you're in a drawdown? When you feel the urge to recover quickly? Or do they shift depending on how you feel in the moment? Because if they shift, they're not rules. They're preferences. And preferences don't create discipline. Now look at this from a long-term perspective. If you break one rule today, you're more likely to break it tomorrow. If you break two, you'll justify a third. And over time, your entire approach becomes fluid, inconsistent, unpredictable. Not because the market changed, but because your standards did. And once your standards change, your results follow. So every small decision matters more than it seems. Not because of its immediate impact, but because of what it reinforces. You're either strengthening your discipline or quietly training yourself to abandon it under pressure. And the dangerous part is, this training doesn't announce itself. It builds quietly. Trade by trade. Decision by decision. Clarity in rules eliminates hesitation in execution. Most hesitation in trading doesn't come from fear alone. It comes from uncertainty. Not about the market, but about your own criteria. When your rules are vague, your decisions become slow. You start asking yourself questions in real time that should have already been answered before the trade even appears. Is this setup good enough? Should I wait for more confirmation? Am I entering too early or too late? And while you're thinking, the market is moving. Let me ask you, how many times have you missed a clean trade, not because you didn't see it, but because you weren't sure if it qualified? That hesitation is not a timing issue. It's a clarity issue. When your rules are precise, execution becomes almost automatic. You're not guessing. You're not interpreting. You're simply matching what you see with what you've already defined. It's either there, or it isn't. But most traders don't operate that way. Their rules are flexible, open to interpretation, influenced by context and emotion. So every trade becomes a small internal debate, and debate slows you down. Now consider what happens when you hesitate. Sometimes you enter late, chasing price, because you finally convinced yourself. Other times you don't enter at all, and then watch the move unfold without you. Both outcomes create frustration, and that frustration carries into the next decision. Do you see the chain reaction? One unclear rule leads to hesitation. Hesitation leads to poor timing or missed opportunity. That leads to emotional pressure. And that pressure clouds the next decision. All because the rule wasn't clear to begin with. Now imagine the alternative. You define your setup in simple, observable terms, not based on feeling, but on structure. Something you can point to on the chart without explanation. Something that doesn't change depending on your mood. When that setup appears, there's no need to think. You act, not impulsively, but decisively. Let me ask you, what would it feel like to place a trade without second guessing it? Without that internal noise questioning whether you're doing the right thing? That's what clarity gives you. It removes friction. Because hesitation is friction between intention and action. And the more friction you have, the less consistent your execution becomes. Now, this doesn't mean every clear rule leads to a winning trade. That's not the purpose. The purpose is to create alignment between what you plan and what you do. When those two match, your performance becomes stable. Not perfect, but stable enough to evaluate honestly. Because if your execution is inconsistent, your results become misleading. You won't know whether a loss came from a bad setup or from poor timing caused by hesitation. You won't know whether a missed trade was part of your plan or a result of doubt. And without that clarity, improvement becomes difficult. So let me ask you, are your rules clear enough that someone else could follow them exactly as you do? Or do they only make sense in your head, shaped by how you feel in the moment? Because if they're not transferable, they're not precise. And if they're not precise, they will break under pressure. Now think about speed. The market doesn't wait for you to feel ready. Opportunities form and resolve quickly. If your decision process is slow, you'll always be slightly behind. Not because you lack skill, but because your framework requires interpretation. Clarity removes that delay. You recognize faster. You decide faster. You act faster. Not recklessly, but efficiently. And over time, that efficiency compounds. Your entries become more consistent. Your exits become more disciplined. Your confidence becomes grounded in repetition, not in hope. So the next time you hesitate before a trade, don't just look at the market. Look at your rules. Ask yourself, what exactly am I waiting for? And if the answer isn't clear, then the hesitation isn't the problem. It's the signal. Most losses begin with a small exception. It doesn't start with a big mistake. It rarely looks reckless in the moment. In fact, it often feels reasonable. You adjust something slightly, just enough to make the trade work. You tell yourself it's a minor change, a flexible decision based on current conditions. But let me ask you, when you look back at your worst trades, do they ever begin with a clear, disciplined plan or with a small compromise? That's where the pattern hides. You move your entry a little earlier because price might run without you. You widen your stop just a bit because the level should hold. You take a setup that almost meets your criteria because everything else looks right. Each of these feels insignificant. But they all share one thing in common. They're exceptions. And exceptions change the structure of your trade. Now you're no longer operating within defined boundaries. You're adapting in real time, influenced by what you feel instead of what you planned. And once that shift happens, the trade is no longer anchored. It's drifting. Think about what that does to your risk. A slightly wider stop increases your exposure. An early entry reduces your confirmation. A marginal setup lowers your probability. None of these guarantee a loss on their own, but together they tilt the balance. And the dangerous part is, you don't always notice it immediately. Sometimes the trade still works, and that's where the habit strengthens. Let me ask you, how many times have you broken a rule and been rewarded for it? How quickly did that reward make the exception feel acceptable? Because once something works, even once, it becomes easier to repeat. You start to believe you can manage exceptions, that you can control them, that your judgment in the moment is reliable enough to override your structure. But trading doesn't punish you instantly for these decisions. It waits. It lets the pattern build. And then, when conditions shift slightly, those same exceptions begin to stack against you. Now the wider stop doesn't protect you. It increases the loss. The early entry doesn't give you an edge. It traps you in a false move. The weak setup doesn't recover. It fails as it was likely to. And suddenly, what felt like a small adjustment becomes a full loss. But the loss didn't start where you think it did. It started at the moment you made the exception. Now consider the emotional side. Once you've made one exception, your mindset changes. You're no longer strictly following rules, so your decisions become more fluid. You're more likely to adjust again, to manage the trade differently, to hold longer than planned, to avoid taking the loss because the trade wasn't standard to begin with. Do you see how one small shift leads to another? This is how losses grow, not from a single bad decision but from a chain of compromised ones, and each step feels justified in isolation. That's what makes it difficult to catch. So let me ask you, can you identify the exact moment your losing trades go off track? Is it when price moves against you, or is it earlier, when you stepped outside your plan? Because if you trace it back honestly, you'll often find the origin is not in the outcome, but in the entry, the risk, or the reasoning behind the trade. A small exception at the beginning creates instability that carries through the entire position. And once you're in that position, your ability to manage it objectively is reduced. Now you're reacting. You're adjusting based on hope, fear, or urgency, and that's where control fades. So the focus shouldn't just be on avoiding big mistakes. It should be on eliminating small exceptions, because those are the ones that slip through unnoticed, the ones that feel harmless, the ones that quietly reshape your behavior over time. Every time you allow one, you're telling yourself that your rules can be bent. And once that belief is in place, the line between discipline and impulse becomes unclear. So the next time you're about to make a small adjustment, pause for a moment. Ask yourself, if this trade loses, where will it have truly started? A simple edge compounds only through repetition. Most traders underestimate this because repetition feels slow. It lacks excitement. It doesn't give you the immediate sense of progress that trying something new does. But in trading, progress is rarely loud. It builds quietly, through doing the same thing over and over, under slightly different conditions. Let me ask you, how many times have you changed your approach after just a handful of trades? Not because it was proven ineffective, but because it didn't feel convincing yet. That's where the cycle breaks. An edge, by definition, is not perfect. It doesn't win every time. It might not even feel impressive in the short term, but its strength lies in its ability to produce a favorable outcome over a series of trades, and that only reveals itself through repetition. If you interrupt that process by switching strategies, adjusting rules, or second, guessing your setup, you never allow the edge to express itself fully. You reset the cycle before it has a chance to compound. Now consider what repetition actually does. It builds familiarity. The more you see the same setup, the more you understand its behavior. You begin to recognize subtle details. How price approaches a level, how momentum shifts, how volatility expands or contracts. These are not things you learn from theory. They come from exposure, and exposure requires consistency. Let me ask you, can you truly understand a pattern if you only trade it occasionally, or if you keep modifying it every few attempts? Because each variation changes the outcome. You're no longer testing one idea. You're testing fragments of many, and fragments don't compound. Now think about confidence. Most traders look for confidence before they commit. They want to feel certain that their approach works. But confidence doesn't come first. It comes after repetition. After seeing the same setup play out dozens of times. After experiencing both wins and losses within the same framework. After realizing that one trade doesn't define the outcome. That's when confidence becomes stable. Not because you believe every trade will win, but because you trust the process over time. But if you don't repeat, you never reach that point. You stay in a constant state of doubt, always questioning, always searching, always adjusting, and that state prevents growth. Now consider the impact on your results. If you execute the same edge consistently, your performance becomes measurable. You can track outcomes, identify patterns, refine small details. You begin to see what works and what doesn't within a stable structure. But if your behavior changes from trade to trade, your results become noise. You won't know whether a win came from your edge or from randomness. You won't know whether a loss was part of the system or caused by deviation. So let me ask you, are you giving your edge enough repetition to prove itself? Or are you expecting clarity from too few data points? Because trading is not about finding something that works once. It's about finding something that works often enough and then applying it without interruption. That's where compounding begins, not just in profit, but in skill. Your execution becomes sharper,